According to Kiplinger's Personal Finance, today's retirees could be facing the perfect storm because they're living longer and spending more time in retirement while at the same time losing access to traditional pension plans. This means, of course, that retirement strategies of the past are going to need some tweaking for today's retirees.
So in this video, we're going to talk about 3 specific risks that retirees are facing today, and then talk about some solutions as well.
So the first risk that they are facing is low interest rates. Now, the Federal Reserve has announced that interest rates are going to stay for the foreseeable future at 0% to 0.25%.
Yeah, pretty much 0%, right?
Pretty much. So how does that impact today's retirees? How is that different than in the past?
Well, historically, retirees would buy bonds and then use the coupon payments or the interest for retirement income, right? If you had a 5 or 6% interest rate on a few $100,000, $15,000, $18,000 a year of interest. Well, today, as we record this video, Amber, 10-year treasuries are at 1.6%. So 1.6% is not anywhere near historically where they've been interest rates, 5, 6, even 8%. So the problem is just buying bonds and using the interest as income in retirement, probably not a very successful strategy for most people.
So the second risk is potential for inflation. Now, how does that impact retirees?
Well, you tell me, you're the one who does grocery shopping. I mean, are we seeing this right now today?
Definitely. Prices going up, up, up.
So to combat the COVID pandemic, the U.S. government spent over $4 trillion between the CARES Act and the American Rescue Plan. So they pumped $4 trillion into the economy, causing it to kind of heat up. Now we're seeing shortages of things. Lumber prices up nearly 400%. Other commodity prices are way up. So we're seeing inflation. Now, whether it's short-term or long-term, the Federal Reserve, Amber, has announced that they'd like to see it at least 2%, and once it hits their 2% target of inflation, they're going to let it keep going for a little bit. They're not going to put the brakes on by raising interest rates, going back to our first problem for retirees. The Federal Reserve will not raise interest rates right away, even as inflation picks up.
So 2% actually sounds like a really small number. So is that actually really a big deal?
Well, Amber, 2% inflation over a 20-year period. Remember, most retirees will be in retirement 25 or 30 years, maybe longer. So 20 years from now, if we have just 2% inflation per year for 20 years, 20 years from now, you will lose over 1/3 of your purchasing power. Almost 33% of your purchasing power gone, which is 2% a year. So it eats away a little bit, the old nickel and diming. They're nickel and diming us, right? That's what's happening in retirement. They're going to lose purchasing power over time. So they either have to lower their lifestyle, reduce spending, or find a way to increase income later in retirement.
So before we talk about some solutions, let's talk about the third risk, which is market risk. Now, we've talked about sequence of returns risk, which basically just means large losses early on in retirement and the impact that that will have on the rest of your retirement years.
The reason it's kind of a concern now, Amber, is we keep hitting all-time record highs. We've had a huge run-up in the market even after the pandemic hit. We're way back past where we were when it hit, and now we're having continued record highs. So people are starting to say, if I retire now, will there be a correction in the market in the first few years? And if there is, how will that impact your retirement? Studies have shown time and time again, losses in the early stages of retirement are far worse than in the second half of retirement. If they're early on and you wipe out a huge portion of your retirement nest egg in the first few years, it could spell trouble down the road for these retirees.
Okay, so this all sounds very scary, the perfect storm for retirees. So let's talk about some solutions.
Solutions? Let's do that. Let's do that, Amber. So let's talk about the interest rate was the first one, right?
Right.
So rather than having bonds trying to produce income, a solution might be an income annuity, right? Figure out how much income you would normally want to have from your bond portfolio and go out and shop that with an advisor to find out how much you could set aside in an income annuity to produce that income instead of relying on low interest rates. Doing that will use up a portion of your principal in addition to the interest, but you'll be able to get a lot more income each year as a result.
And we actually have done another video on income annuities, and so if you have more questions about that, don't miss that video. Okay, the second risk that we talked about was inflation. Now, what are some solutions for that?
Well, Amber, the solution to inflation risk is continuing to be invested in the stock market. So even as you get more conservative as you near retirement, still having some investments in the market with your risk tolerance in mind, we're going to talk about that in the next solution, keep some money invested in the market to get those bigger returns so that you can increase income in the future.
So this maybe sounds a little counterintuitive for the third thing we talked about, which is market risk. So how do we sort of put those together?
So staying invested in the stock market while reducing market risk, well, let's turn to the Kiplinger's Personal Finance article. The Kiplinger Personal Finance article recommends that you meet with an investment advisor to find some alternative type investments, some structured notes, for example, they use. Now, we have one of those available. It's called our buffered index. If you go to New Gen Buffered Index, those change every month. But what essentially it is, Amber, it allows you to invest in a portion of the gain of the market index, like the S&P 500, and be protected at some level on the downside should that index actually lose value.
So give us a real life example of how that works.
So today's buffered index portfolio, Amber, says if you invest for 1 year, we'll track the S&P 500 index. If it goes up, the investor gets the first 10.75% gain. If it goes down, they're protected on the first 10% loss. So market goes up 10%, you get 10%. Market goes up 15%, you get 10.75. Market goes down 10%, you get zero. You don't lose anything. Market goes down 15, you lose 5 in that portfolio. So we're really shrinking the amount of upside and downside potential here with these structured notes.
So one thing we really recommend for our clients is that you actually take a risk tolerance quiz that you can find at myriskcomfort.com. Very short questionnaire, but it will help you understand where your risk tolerance is and what kind of risk you are comfortable with.
So by using some smart strategies, annuities for income and to offset the low interest rates, and then investing in the market to beat inflation, but minimizing the potential for market risk, using our buffered index portfolio, you can really provide for a pretty comfortable retirement and really eliminate the risk of this perfect storm, as you called it, for retirees.
And as always, if you feel like you need extra help with this, you can go to workwithnewgen.com and schedule a 15-minute introductory phone call with us.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.